You made some waves with this report, and the parallels and the comparisons you draw are between London and Hong Kong. Talk to me about that.
Sure. I think one of the points we make in our report is that prices depend on expectations in addition to financing. And Hong Kong is just a very extreme case of a property bubble that fell down by 40% within 12 months. And it did because people changed their view of what the market would do. So the stories people told were very similar. Supply constraints, there were political constraints against building houses, emigres were coming back from overseas, mainland China was nearby, and that did not stop the prices from falling when people's expectations changed and when financing conditions changed.
For a lot of people along the property market, they sit here and they say, forget about it, I've heard this argument so many times over the last 5 years. For those of us that want to be long the property market that can't, we sit here and pray that Sahil Mahtani is right and that at the turn of the year the market does indeed turn. Sahil, the pushback you've had over the last few days, what is the pushback you've had and what is your response to it?
I think people have said this, other people have said this so many times before, why now? And I mean, the first response I would have is that just makes all the previous predictions wrong, not this one. But the second response I would have is there's actually very limited upside. So there's bank rate, which is now at 0.5%. Compare that to 2007 when it was in the 5s. So that massive tailwind households got from falling interest costs is now gone. There's now housing has become a political issue, perhaps more than it has been at any time in the last 2 or 3 decades. Home ownership peaked in the early 2000s and has fallen every year since, even in the presence of a Conservative government who is expressly dedicated to increasing home ownership. So I would expect that even if prices did rise, if home ownership fell, you would have a supply, you would have a political dynamic that would create the conditions for further intervention into the housing market. And the third is that macro-prudential policy is really kicking off. I think former Governor King was not a huge fan of macro-prudential policy. Current Governor Carney is, and he views that as a way of constraining the risks of financial instability while still preserving the low cost of credit to the economy. So I think all those 3 things suggest to me, at least, that there's very limited upside and quite significant downside.
So let's talk specifics. You mentioned the politicisation of the London property market.
Sure.
You also mentioned Governor Carney, who voiced those concerns all over again over the weekend on the mortgage market specifically.
Yes.
If I'm to sit here and expect more macroprudential policies, what form do they take? What do they go after?
Sure. I think the previous macroprudential policy was limited to owner-occupier housing, where they limited the amount of risky loans that could be made by banks, new loans that could be made by banks for those. I think buy-to-let has been a significant concern, both in fiscal policy interventions in the budget, but also macroprudential policy later this year, perhaps next year. I think macroprudential policy has a long way to go. If you look at Singapore or Hong Kong, which have been practicing macro-pru policies since at least the 90s, they have differentiated treatment for second and third homes. They have differentiated treatment for non-resident buyers. These are all the degrees that you can imagine macroprudential policy taking into the UK as it ramps up, because it's, after all, a very new thing.
Is it a financial stability risk for the rest of the UK economy? I asked that question because I remember sitting in an inflation report over on Threadneedle Street at the Bank of England, and Governor Carney said he doesn't set policy for inside the circle line. I wonder if inside the circle line becomes a problem for the rest of the United Kingdom. Does it? Consumption is
2/3 of the economy. Households in the UK are incredibly levered to low rates. There's 1.3 trillion of mortgage debt in the UK, half of which is variable, the other half of which is effectively variable because it's basically a 2-year fixed. So, sure, if you did have a change in financing or you had a change in expectations that pushed prices lower, I think it would affect consumption, and therefore it is a risk to the economy.
The last thing I want to talk about is this feedback loop coming from abroad.
Yes.
We haven't mentioned foreign buyers. Foreign buyers have been the big part of demand in the London property market over the last 5 years. And people will come to me and they'll say they're cash buyers, even though we don't know where the cash has come from abroad. What is the big driver for them, and what does it mean for London as far as you're concerned?
I think that's a complicated question. There are many reasons why outsiders buy houses in London, and there are many reasons why that could change. And I think it depends on a lot of idiosyncratic factors in different countries. But I would end with something that Rudy Dornbusch, the economist, used to say, which is it takes a lot longer to happen than you think it would, but when it does happen, it happens a lot quicker than you think it could.
Sahil Mahtani, analyst at Deutsche Bank. Great to have you with us this morning.
Thank you so much.
Generation Rent hoping he's right, and a lot of people watching this programme who are London property really hoping Sahil Mahtani is wrong. Thank you very much.